China, once the engine of global economic growth, is now losing its steam. Its economic slowdown is sending shockwaves around the world. As the world's largest importer, China's decreased demand for goods is affecting countries from Australia to Europe. This slowdown is particularly impacting commodities like iron ore, crude oil and luxury goods. According to Goldman Sachs, this slowdown will negatively affect iron ore imports from Australia and Brazil. Crude oil imports have already fallen by 3.1% from January to September, affecting global energy markets. China has contributed around 30% of the world's growth since the 2008 financial crisis. However, with the country's economic slowdown, the impact is now being felt worldwide. The country's 126 trillion yuan GDP is under pressure, and despite stimulus efforts, domestic demand remains weak. China's September inflation growth slowed to 0.4%, down from 0.6% in August. The ongoing property crisis, now in its fourth year, is reducing demand for steel and iron, further weakening China's role as a global buyer of construction materials. Southeast Asian nations and countries like South Korea and Japan are also feeling the effects of reduced Chinese imports. China's weaker demand for imports is reshaping global trade dynamics as countries that rely on Chinese consumption see declining export growth. Luxury goods from Europe, machinery from Vietnam and Thailand, and high-tech products from South Korea and Japan are all facing reduced demand. Despite Beijing's ongoing stimulus measures, including monetary easing and investment plans, China's economic activity has yet to show significant improvement. At the same time, Chinese exports of lower-cost goods like cement are rising. South Korea, for example, may start importing Chinese cement as early as 2026, benefiting from prices that are 15% lower than domestic rates.